Rajbikram Nayar, thank you for speaking with us. A little bit about you. You've been born and raised in the US on the East Coast. Your education was in the US and your professional life started with Lehman Brothers, post which you founded Ontogeny Capital with like-minded professionals who are currently executing cross-border transactions. You've been working in the investment banking space for the last 27 years on cross-border transactions between North America, Europe, Israel, and India. Ontogeny Capital is an industry-agnostic advisory firm that has been working across capital structures along with its ecosystem that they have formed on Wall Street, which has executed greater than $1 billion worth of SPAC transactions in the last 3 years. To start off with, Rajbikram, special purpose acquisition companies, otherwise known as SPAC, could you share a little bit about us, as this is probably becoming the buzzword in the industry now?
Sure. Thanks for that, Robin. Appreciate your introduction as well. So Robin, SPACs, and I'm going to talk in layman language so your viewers can understand it in a much easier manner. SPAC is basically a financial product. It's an acronym, which you rightly said, it's a special purpose acquisition company. Now, you know, what SPAC has is basically is it's a publicly listed vehicle on literally any exchange, obviously, but it's relevant to the United States because the laws are very appropriate for protection of not only the investors, but also the sponsors. So in a SPAC, you have two entities. You have a sponsor of a SPAC who basically is, it's a team who is looking to raise capital. Now, the team brings credibility forward from their professional lives. So specifically, these team would be consisting of, let's say, 3 to 4 professionals that have very solid corporate finance experience. When I say corporate finance, they understand how to raise capital. They understand how to do a merger or an acquisition. And also they understand deeply operations in a specific industry that they've spent their lives in. So these are generally C-level professionals, individuals or entrepreneurs or promoters or founders, you know, who've got more than, 15, 20 years of experience, ideally in that sector. Now, the team gets together without a target in place. They basically would come to someone like an Ontogeny Capital and our ecosystem, which consists of a FINRA registered broker dealer, the underwriter itself, a law firm, an auditing firm, and we would set up a NewCo. That NewCo would list on the NASDAQ or the New York Stock Exchange. Our objective would be to go to a roadshow and talk to the traditional multi-strat funds and various types of financial institutions like the Fidelities, the BlackRocks, Soros, the Wellingtons, the Wiseman, the AQR, the Polars, who basically will write a check. So let's say hypothetically, the team wants to raise $100 million. Now they understand an industry, they understand global finance, they understand corporate finance, and they have aspirations to be global in their thought process. So then you come to us, we take you with our ecosystem to the institutions. The institutions will write a check to raise 100 million, for example, and that $100, the institutions will end up owning 80% of the equity post-IPO, and the team will end up owning 20% of the equity. So the cost of this expense generally for $100 would be somewhere between $4 and $5 million. Now, the team would be expensing and capitalizing their expense, and in return, getting 20% of the equity. And 100% of the capital that comes into this vehicle comes from the institutions, correct? And the institutions end up with 80% of the economic rights in that vehicle. So now what you have is a $10 a share That's when you list at $10 a share of a company, which is basically India Acquisition Corp, let's say, for example, for lack of a better name, IAC. Now in IAC, you've got a bunch of guys with great credibility owning 20%. They've invested between 4 and 5 million to do that. Those costs entail all costs: statutory costs, legal costs, auditing costs, investment banking costs, underwriting costs, all costs encumbered. And they basically end up with $100 million into a trust account. Now that money, Robin, sits in a trust account. So like a Morgan Guarantee Trust or a JP Morgan Trust. So it sits there. It's got a lock and key in it. Now by law, the regulator has allowed the capital to earn, interest based on, or return, I would call, based on a money market 180-day financial instrument. That means the institutions who have put the money in the trust, that trust is under lock and key. The sponsor team cannot use that money at this time. It's basic. That's why, and they cannot offset their expenses either, basically. And what you end up having is a situation where that money of 100 million earns a US Treasury bond return. Okay? So, which is very minimal. It's not much. So it's basically, by law, you're allowed to invest in a 180-day money market, fund. But generally, the institutions would like it to be safe, money safe there, because the objective of a SPAC is that once you raise the money, you need to find an operating target to merge with or to acquire. That's the objective. So when that happens, that's called when your business combination is complete. At that point in time, a company with basically cash in it and an operating target with operating metrics in it will merge, and the cash will go up, and then you move forward. That becomes an M&A transaction specifically. So generally, SPACs have a tenure of about 2 years, generally, and it depends what you negotiate, but there's SPACs that have had a tenure of 12 months also, SPACs with a tenure of 18 months. So it's how you negotiate, how the sponsor team negotiates with the institutions when they raise their money during the roadshow. But after that, SPACs have also tend to go beyond 24 months. But at that point in time, that means the team has been unable to find an appropriate target to merge with. So then to extend the time, they basically, they can go as far as maybe another 1 year by quarter going forward. So that's kind of the length and breadth of the tenure of the SPAC. And it needs to find a target to merge with.
Thank you for that, Rajbikram. Let's just look at the current global scenario now and apply this concept of SPAC within it. We know that the world is in the throes of a pandemic. Countries are fighting back. They're looking for a vaccine, which is probably going to try and put everything back to rights again. In this current scenario, how important or how is SPAC now becoming the more preferred form of companies or individuals coming forward to use this for investment purposes?
Got it. So let's step back, and then I'll go into to answer your question appropriately, because I think the viewers would like to understand how the SPACs came about, why they were a risky instrument, why they've come up as a product of age. So SPACs came out in 1993. The term was actually coined by two individuals on the street. That's Steve Levine and David Nussbaum. Those are the first generation SPACs. They were involved. They predominantly were, in the OTC or the pink sheets market, the junior exchanges. The SEC, the investors wanted, better rights with respect to a SPAC. So the institutions basically, the SPACs went from a first generation to second, third generation, where we are now, where investors have rights to redeem their cash. So what that means is they might have put in $100, like my previous example, but they can always give a shareholder a signal that yes, affirmative vote, that yes, you can merge with this operating target the team has brought forward, but I have the right still to redeem my cash, right? This is very important, which is generally overlooked. And so that's a very, good investor right that's given. On the flip side, from a sponsor's perspective, in the prospectus, when they raise a SPAC, basically they're not only disclosing that we will raise this money for a specific geography and a specific industry, but in the same breath, it's written in the prospectus that if we're unable to, as a team, find a target in our industry, in this geography, we have the right to use the SPAC capital to find a target in any industry, in any geography. So the flexibility is there for the sponsor as well. So what's happening today in the market is that, as you rightly said, with this pandemic happening and so forth, why has SPACs all of a sudden started to gain a lot of momentum in the last 3-4 years? Why? Well, a lot of for example, your large financial, private equity institutions, which have portfolio companies, and generally, when you are a general partner or your partner in a private equity fund and you've raised one vintage, which possibly lasts for 5 + 2, 7 years or 9 years, whatever your vintage is, you end up, you need to find exits for your portfolio companies, whether it's through M&A, whether it's going through public. So this is what needs to get done in order for the partners to go raise the next vintage of capital. So what's been happening is, in the last few years, the markets have been very tumultuous. They've been going up and down. There's been a lot of gyrations. And SPAC is just an excellent product for these large institutions to find a liquidity event for their portfolio companies, right? And that makes it all the more better. So with this pandemic onset, for example, this year alone, you'll be shocked, $40 billion have been raised from January to August, this calendar year, which is the highest ever. Till date, we've had close to 420 SPACs raise capital since 2009, 420. And I believe approximately 75 of them were raised this year alone. And I'll correct that number by reviewing my numbers, but it's significant. And the reason is because your institutions are looking for exits, and it's a very elegant way to basically exit your portfolio. Because what is a SPAC merger? It's basically a very involved process of synchronizing, structuring, marketing, legal, audit, and regulatory processes all in one. So basically you get a closed transaction. It's an M&A transaction which merges with SPAC capital. That's it. And you've de-SPAC'd it.
So Rajbikram, correct me as I go along with this question. Obviously, as we see and as we are both, as you have witnessed in the market, because you have the first-hand knowledge, markets are turbulent, they're tumultuous, but there is also these disruptive times have given birth to a very new kind of aggressive investor. Would I be correct in saying that? And they are obviously moving forward more aggressively, putting their money into more out-of-the-box investments or looking for solutions. And the SPAC is obviously coming into play here for institutions and individuals who have a lot of disposable income or cash flow to invest in these current times.
Ultimately, it's all about return and risk analyses, right? Ultimately, it boils down to that. So let's say if I'm a sponsor of a SPAC, right? I put in $4 to $5, I raise $100, I get $20 million worth of shares. So my notional return is 5x, right? In how much time? In 100 days? I drop you $100 million in a public vehicle, and in 100 days, I've invested $4 to $5 million on the expenses to do that for 100 million, and I'm getting $20 million worth of shares. I've got a 5x return, right? The institutions have a similar return as well, obviously. They're also moving forward. But the real return comes once the merger is done. Once the merger is done, so let's say within 12 to 18 months, you actually close your merger. So it's all about return analyses, right? And the risk involved in that. So where's your risk? Your risk is really the initial capital. I would say when you retain an investment bank, an underwriter to move forward with you, and also a law firm and possibly the auditing firm. That's it, right? That's your risk. Because once you've got an S1 filing in place, right, on an IPO, your road show's obviously been executed. That's when, so you end up, paying the investment bank and the underwriters on success after that. So majority of your risk is there, right? Is that initial part. And with that low leverage, and you're just going forward and closing a deal. That's it. So I would say it's not about disposable income. It's about simple math. And the market has realized, hey, SPACs are a great way to raise money. The institutions are there, and the retail investors are kicking in. And as far as it's an elegant way of actually, instead of going IPO with a target, which, in the last week it gets priced, here it's really an M&A deal. It's a reverse merger. You're merging into cash, right? And your jugular, when I say in colloquial terms, is not exposed because no one knows why the merger didn't happen or did happen, right? So you're safeguarding yourselves from market volatility and dynamics and people realizing, as was a target overly priced or not, because there could be multiple reasons why a SPAC M&A falls through.
Rajbikram, you're now currently based in India, if I'm correct.
I spend a lot of time in India.
Correct. What are the ripples that you are seeing that this is creating in the Indian ecosystem right now with SPAC?
Well, SPAC is a very novel idea. People are reading about it thanks to the press and people like yourselves in the media space. But honestly speaking, it's still very, very nascent stage in India. It's very nascent stage. I mean, there's hardly been, you can literally count on your fingertips the number of transactions out of India since 2015, 16, right? One of the early ones was, if I remember, was Videocon DTH, right? And they had merged with Silver Eagle Acquisition Corp on Wall Street, which is a media SPAC. So that was one of the early ones. And Videocon was a publicly traded company on Bombay Stock Exchange. So they had to carve out a new co with an American depository receipt. And that's what merged with the SPAC, right? It was a very tax efficient, but even our regulatory environment, for example, SEBI and RBI, they're also coming of age with respect to SPACs and SPAC mergers and so forth. So the ripple effects are, I think the more and more industrialists and promoters I talk to on the subject, they want to figure out, well, the market is tight, capital liquidity is constrained, Indian businesses are not easily getting funded by banking institutions here, and that's just based on the general macros. So, when someone says, wow, you can literally in 90 to 100 days or 110 days maximum, you can drop me 50, 100, $200 million in a publicly traded vehicle, your eyes get starry and your ears start to think, whoa, what am I missing? What is this? I want to know more, right? And I want to understand the negatives behind it. Of course, you're talking about raising capital in a market with depth. Compliances are going to be an issue. So compliances are very, very important. And it's not that they're going to be as much as an issue, but they're very expensive. So when you compare going public on the Bombay Stock Exchange, your cost of compliances on an annual basis is far less than compliances on the NASDAQ or the New York Stock Exchange. But your ability to raise money, your ability to ensure there's liquidity in your stock, your ability to be able to raise lower cost of debt because you have a public equity, your ability to ring fence yourself from, I would say, liabilities at a promoter level gets enhanced further because you're a publicly traded equity once you've merged with a SPAC, right? Because SPAC is just a vehicle with cash, that's it. And then the merger, you become just another publicly traded vehicle on the US stock exchanges. So the effects are, you're absolutely right. we're more busy than ever before. I mean, we spend a lot of time educating industrialists in India right now and promoters and professionals. We're doing a lot of education, and it's free education as it is. But the idea is at some point, more and more are going to take the call to move forward.
Rajbikram, you said that you are educating the investors in India, and obviously when you do that, you obviously have one eye on opportunities for the future. And when you apply that to the Indian ecosystem, what would you say are the opportunities for the future when this comes to fruition with SPAC?
A good question. I think I can lead into something. So, for example, we've actually Ontogeny taken warrants in an electric vehicle company in India, okay? Without naming it. The company, we believe, is a potential unicorn. They address the mid-mile and the last mile market in logistics space, right? They've created an amazing vehicle, not a prototype. They have a standing customer already, which is one of the largest global logistics players in the world. And what we saw in them, so we were mentoring them, we were talking to them, we were discussing with the founding team. They've created an exemplary board. They've spent 5 years in R&D. They were in stealth mode. But what we realized was that this would be an ideal company for a merger with a SPAC at some point, right? And the way we see it is, at the moment, the company's basically getting their vehicles ready, street ready, and they've already got 2 vehicles on the road with a customer, and they're going to now grow but they have, letter of intent for orders worth more than about 5,000 vehicles already, right, in hand, and the average cost of vehicle being that $12,500. That's $60 million worth of orders. I mean, literally, they have, right, and the objective is, and our model works this way, is when we look at startups, we love to take warrants, we get them some money, and then we get from our relationships, family offices that love public equity, get them anchor investors and merge them with a SPAC, right? So we would hope, and I'm taking it off your cue, what you asked me, what's, what we're looking at right now. So when we go in, we look with the eye of a future potential SPAC candidate, but we go in them now for advisory. And we also look at, taking warrants from an investment perspective with our ecosystem. That's how we work.
You say when when you explain it to people and you break down the SPAC and the advantages and the benefits that come with it financially, it's like music to their ears. But obviously, you would always, help people to tread with caution and give them enough education and more awareness as you are doing now. What is the knowledge that you are actually imparting to companies on the ground who are looking like potential investors?
Yeah. So, I mean, look, number one, you need to, first of all, ensure if you're looking to merge with an existing SPAC, that means which has money in it. So you're not raising a SPAC, but you're looking to merge with one, and you want liquidity and you want capital. One thing you need to be aware of, that you need to have PCAOB audits done for your company. Generally, these audits need to be done 3 years in the past, along with a stub period, what you have now. So you would be following, for example, Indian, accounting standards. That would not work as per SEC regulations. You would need to look at either IFRS, but ideally, if you're going to be merging with a SPAC in the US and hence be a US domiciled company, you'd probably want to rewrite your financial statements in US GAAP and then have it audited. And that itself is a very cumbersome process. It can take, anywhere between 45 and 90 days, depending how hungry you are to move quickly. So that's one. Second, now, of course, the cons, I don't want to call them cons. I want to call them, comparative analysis. If someone were to merge with, money in a public entity in India, or someone were to go IPO straight, and with respect to a SPAC in the US. I would say compliances, I've touched upon it. Compliances are strict. Compliances, because you've got a very mature market, right? Compliances are strict. Compliances, but that's good for you as well as a company to grow globally. Compliances are expensive as well. So, traditionally in India, if you were to have a cost of a public company annual compliance, let's say about close to $250,000 to $300,000. So, which is about 1.2 crores to maybe 2 crores on the in the early days. In the U.S., you're looking at probably $750,000, to start with. So your compliance cost is high, right? But then please understand your average cost of debt being a public entity is going to be much lower, right? Traditional corporate debt that you can raise there is far, far lower, right? And we're compared to the Indian market, right? So you get access to certain types of financial instruments that you wouldn't have here, right? Then your investor relations part, when you're looking to do this, is absolutely critical, because ultimately you're going to have to own up to the street, to the numbers. So your IR function, extremely important. Your ability to appropriately and eloquently explain your business model and your growth and your risks and rewards that are coming from your business, all the way operating in India, to the equity research analyst on Wall Street, extremely important, right?
India is currently in a very exciting phase as far as the economic ecosystem is concerned. There have been reforms. The country is pulling in FDI. There's so much happening. There's activity. Of course, there's the problem with the pandemic as well. But India is fighting back, and all that is very exciting. How does India excite you when you bring your goods to the table?
Oh God, it's the wild, wild west, in my opinion. What opportunities! There are amazing opportunities here. Look at the country itself. I mean, you've got the youngest English-speaking population in the world. You've got 400 million individuals of literally disposable income. You've got penetration of smartphones at exponential levels. I mean, literally, you've got 400 million smartphones in this country. Look at the cost of data, thanks to Mr. Ambani and Geo. I mean, the cost of data is the lowest in the world, right? And we're living now in a digitized world. I mean, everything is becoming digital, So I think, in my opinion, the next couple of years, the entire world is going to go through a lot of changes, right? Including India. But I personally believe, being an Indian at heart, but also the fact is that just by the macros that India brings to the table, I believe it's going to be the most shining decade going forward for India. And I think every global company should have some relation with India. That absolutely is critical. They should have the ability to understand India from a regulatory process, from a legal framework as well, and as well as, how does the country tick? How does it move forward? I mean, you've got, the rural sector, which is moving at a amazingly nonlinear exponential way, trying to catch up with the urban centers of the country. So, I'm very excited. I mean, I lived 37 years in the US, and I decided to come here and spend more time here. It's because, the country, is going to spit out, the next bunch of unicorns. I mean, it was China's story 10 years. For the last 10 years, it's going to be India's story now. I don't say India is going to be the manufacturer to the world as China. That's a very sweeping statement to make, and I don't make that. But I think India's growth is taking place. We've been a services-led economy for a long time. I think we missed the boat slightly because the investment in R&D was lacking in the country. But I think now, more and more, India is understanding why investment in R&D is important. That's how America grew. That's how Western Europe did well. China has done very well in that as well. So, I think, as long as we have a stable government, we have checks and balances of power. I think that's very important still. We are a democratic country. And I think as long as liquidity continues to rise, thanks to the global FIs that keep coming in, and I think as long as India becomes cautiously risk tolerant, when I say India, I mean Indian financial institutions start to become cautiously risk tolerant by employing appropriate, checks and balances internally, by taking advantage of, digitization, technology, specifically in artificial intelligence, machine learning in these areas, which actually seeds through all industries. Literally, it's the future. So as long as, and given the fact we're a very strong engineering country with a lot of engineers and medical professions, I think India will do well. I think India will do well, and we're here to stay. We're here to stay for the long term.
Rajbikram, speak to me about the startups in India. Obviously, do you see a lot of potential there?
Absolutely, absolutely. I mean, look, I think we're gonna see a lot of. There's been a lot of reverse brain drain that's come from the United States and Western Europe in the last few years. So people from Silicon Valley have come back. They've decided to, put their, come back here and look at different, thought processes of starting up with great experience with multinationals. So they're bringing all that to the table. I think the startup ecosystem and also certain regulations that the government, the Ministry of Finance has put out, I think it's very helpful. I wouldn't want to go into the details of what advantages the government is giving to startups, but I think it's obvious, and I think it's actually shaping up well. And I think the ecosystem is growing. And I think traditionally Indians, are just very intelligent individuals, and they've done very well globally. So why not in India, and why not benefit India in the process?
So the projected target of $5 trillion you think is well within reach then, as projected by the Prime Minister at one time? Would it be fair to say, under the current circumstances with the opportunities that present themselves?
I'm not an authority to neither counter nor state that what the Prime Minister has said. But I will say one thing, that we're in a positive direction. We're doing well. And when we mean India, India is doing well. It's moving forward. We've managed the lockdown fairly well, even though rates are, spiking. But we're a resilient community, and I think we know how to deal with hardships. And our time is coming. Maybe 24 months out, I think we will see a lot of interesting things.
And this will be a happy hunting ground for SPAC then, obviously. That's my final question.
I hope so. I mean, SPAC was always like an exotic financial instrument, but I think it's come of age. I think SPAC is no longer an adolescent. It's come into adulthood, and I think it's here to stay. Time will tell what happens in November with the US elections. So let's see who comes forward and how the geopolitical scenarios work out with India early part of next year. I think SPACs are now a product which have matured, and I think they're here to stay, and we hope so.
Rajbikram Nayar, thank you so much for giving us your time and sharing your expertise with us. We're very grateful.
You're welcome, Robin. Really appreciate it. Take care.